Hello, ladies and gentlemen, and welcome to our interview with Juan Carlson. Juan is the CEO of SRA SRA 831B, which specializes in mitigating risks for small to mid-sized businesses. So Juan will explain us what does it mean, this specific number. So Juan, welcome to our risk management show podcast today.
Yeah, thanks for letting me on, Boris. I'm looking forward to our conversation as always. So thank you.
Absolutely, absolutely. I believe that we will have a very thoughtful conversation on the topic of how small to middle-sized business can use this rule 831B admin plans to help mitigate their risks. But before that, could you please share a short story about your career path, what brought you to where you are right now, and what you guys at your company are up to these days?
Yeah, so I've been really in '96. I took my first property and casualty test to become an insurance agent. For our company's headquartered in Boise, Idaho, here in the U.S. And that's how I started. I mean, I started in risk management. As any agency starts out, you wear all the hats, and with success, you're able to hire people and grow my agency. I grew it to about 6,000 policyholders. We and eventually all I had was business owners was my clients. That's the one piece I kept. It's the one hat I kept. Was working with business owners. And then, we experienced in '08, the Great Recession. And then during that time, I kind of looked at what was going on and realized there was a substantial amount of financial risk business owners were taking that traditional insurance carriers just weren't going to do a good enough job for them, unfortunately. We talk about it all the time. I think traditional insurance does a great job when it comes to the risk profile of a business owner with a lot of tangible assets, the buildings, the vehicles, business property, all of that stuff, general liability, excess risk, all of that stuff. But it all has to do with the tangible assets of the business. Most business owners today value the intangible assets of the business more so. And the intangible is really any intellectual property, customer list to blue sky, cash flow, any of those types of things where it's generating the cash flow would be considered an intangible asset. Traditional insurance carriers kind of fall down on that. Now they do have business interruption policies, but you have to have a triggering event on your, you have to have a direct loss on your property or your location before business interruption triggers. So from my perspective, that's when I thought there's had to be a smarter, better way. And I was introduced to this concept, and really it's self-insuring risk. And the 831B, all the 831B allows you to do is so you can self-insure risk today, and you can say, hey, I'm going to expense it out of my company, my warranty risk, my cyber risk I can't buy insurance for, down to dispute resolution, to supply chain risk, to brand protection, and there's a list of things that we do out there in the world of risk mitigation. And we call those unfunded liabilities, meaning you can't transfer, I can't transfer a risk. I can't buy a policy, pay a premium, and I transferred that risk to the insurance carrier. I'm just retaining those risks on my books. Now, how do you risk finance those, right? And so then you can just simply say, okay, I'm going to do that. I'm going to form an insurance company. And I'm going to say, hey, if something happens, I'm going to expense it on my operating company. And I'm going to dump it over in this vehicle. And those vehicles are typically known as captives. So, you got your big companies doing it all the time because nobody's selling Microsoft, for example, product liability, right? That's a self-retained risk. They're just going to fund it. They're still going to expense it and drop it into their own insurance companies. And a lot of Fortune 500 companies, publicly traded and large companies, have all their own insurance companies known as captives. And then you got your middle market doing it as well. Now, the only difference between what we do and what all that arrangement is, an 831B, if that's where the tax code in the US sits, no different than when we talk about a 401k retirement plan. The 401k is just where you find in the tax revenue guide, tax code, and in the 831B is the same thing, Boris. So, but here's what the 831B allows you to do. The money you're putting into the captive stays tax deferred. No different than the 401k proceeds do. What that does is allows you to build up your reserves and surplus faster within that vehicle, so you can take on the risks that you're funding for. And it gets down to a simple conversation from my perspective. If a business owner has these risks that are unfunded and they want to risk finance those, and they're going to use their own money to do it with, do you just want to use pre-tax dollars or after-tax dollars? And that's it. It's not, I don't want it to sound too complicated. We go down this road of talking to business owners, and, if we start to build a rocket ship pretty quickly if we're not careful. But that's really, that's the simplicity that we try to approach with the boards is this. If you got this risk, it's undeniable. I mean, we can talk about COVID and all the other things that happened with that, but where insurance carriers weren't going to, traditional insurance wasn't going to respond to it. Do you want to use pre-tax or after-tax money? That's what the 831B allows you to do. All you're going to elect when that captive does its tax return, you're going to elect under the 831B tax code. This year, starting in January of 2024, the IRS is allowing us to put up to $2.8 million away into this vehicle. Now, there's actuarials, there's 4-part tests, there's regulations and everything else that you have to adhere to in order to elect under the 831B, and that's where we come in as the administrator of those plans. No different if you're in the U.S., you're going to have to hire a 401k administrator to administer your retirement plan. You can't just do those things on your own. You can't also own just an 831B or elect an 831B and do those on your own. You're going to have a manager to do that with, and that's where we come in.
Okay, fantastic. So you provided a brief overview of what 831B plan means and how they differ from other mitigation strategy. Maybe can you explain what is about a current risk landscape? So given the uncertainties and risk businesses face today, what are some of the key challenges that the small to middle-sized businesses encounter, and how does this make your plans or captive to be easy for me to pronounce it captive than to this number, because we spoke before you we have some guys from another captive insurance companies, Bahamas, I think, also, and also one in America. So what is kind of make it different?
One of the things that, in order to bridge that gap, for business owners, we simply say, listen, so we had the paycheck protection plan here in the United States, known as the PPP plan. And basically it was a government subsidy program. So when COVID first came on and we were going to shut the economy down, the government gave out a bunch of money. And now I think the world is starting to feel the repercussions for all that as well, unfortunately. But that's neither here or there right now. But what we're doing is telling, listen, all business owners should have their own PPP plan. It just needs to be self-funded. So that's all an 831B is going to do is self-fund. So a good example is business interruption today. If you don't have a direct, I was just saying that earlier, if you don't have a direct loss on your property, there's not triggering business interruption. But, I was just talking to a gentleman down in Florida. His business was shut down 3 different times last year. The hurricane never hit his property. Never hit the beach. It went further north. Meanwhile, his business, he lost almost 3 weeks of operating. His bills didn't stop. His employees still wanted to get paid, but he had no commerce going on because he was forced to shut down with the intent of evacuating on a hurricane that never happened. Those are all, and we can go on and on about the business interruptions events that occur all the time. And if you're a big Fortune 500 company or a large company, you can weather that storm pretty easily and quickly. But if you're a small to middle market business owner and you're volume driven, you can't afford to have one day shut down unexpectedly. And here's what happens. All you're going to do is drain down the cash flow. That's the sole purpose of business interruption, is to maintain the cash flow of the business. So, if my restaurant burnt down, it triggers business interruption. Well, it's still going to cover my rent. So if I own the building, it's going to cover my loans. My employees are going to stay working, so they don't. When we rebuild, I can open the doors and I still have my cash flow to operate my business. If you don't have any of that stuff, you wouldn't be able to open up the doors because your cash flow will be gone, right? So that's the whole point of business interruption. But I would be remiss to tell you, Boris, that in today's world, I think more and more indirect losses are incurring more than direct losses a lot of times, and those are just simply not going to be covered. When you start relying on third-party administrators, and what I mean by that is my CRM systems. We're putting everything up in the clouds, right? So I'm relying. It's not my server on property anymore. It's up in the clouds. So when you look at cyber risk today, I'm dependent on that third party guy to do what he's doing to make sure he's not going to lock up my, but how many times is that happening right now? And of course, a lot of it goes unreported, where people are just locked out of their systems. They can't help their clients. They can't service them. All of those things are occurring today, and insurance companies are going to keep adding more and more exclusions to the policies. We're seeing that already in the United States. When the code came out, it came out in 1986. The 831B came out in 1986 in our country, U.S. And it's almost in exactly the same environment we're in today. High interest rates, reinsurance market carriers were getting out of the market, putting a carrying capacity what carriers are willing to take on now, or they're just going to have to charge higher rates, or they're going to have to add more exclusions into the policy in order to even accept the risk. And so we almost got that same environment today in soon to be 2024 as we did in 1986, almost 40 years later. But it's one of those things where, and then, of course, fast forward and how much more our world's gotten complicated with supply chain risk, with global economies, age of information, the social medias, brand protection. Anyway, so I can go on and on about risk, and maybe some of your viewers are like me that I get geeked out on that, and I enjoy that. I do. I don't know why sometimes, but I do, and I can talk about that forever. But anyway, I want to move on.
It's a bug. It's a bug for risk manager. So you did a good job explaining the advantages of businesses being business resilient to implementing these plans. But let's discuss a potential misconception. I have what is the major misconception in your field of maybe you can think myths surrounding these plans?
No, there is. I mean, it's a tax code. So, unlike a lot of parts of the world, Boris, Americans hate to pay taxes. We despise it, I think. It's been, I continue to get, and so here's the thing about tax codes. When Congress comes out, they create incentives for you to do. Really, it's incentives. It's a manipulation of your activity, right? So Congress comes out and says, "Here's an incentive. You can own your insurance company and you put your money away, expense it to your operating company, dump it over here, and keep it deferred." When that happens, it's sad to say, but it is what it is. It's going to be abused. The code was abused. The code was abused not for risk management, unfortunately. It was used for estate tax planning. So we had some really smart attorneys here in the country, in the U.S., take the code and do exactly what it was not designed to do. And it was to, do a wealth transfer vehicle. Well, and I have a really, and IRS doesn't, the tax paying revenue service, the Internal Revenue Service doesn't like it. They don't like anything that has advantages for taxpayers, right? Their job is in direct correlation to collect as much tax revenue as possible. So there's the butting of the heads on that stuff, and whatever. From my perspective, I'm a risk manager, and clients ask me all this question all the time, and I tell them quite frankly, if you're doing this for taxes, go find somebody else. If you have strong risk concerns, or you're losing sleep over this, and you don't have a way to fund it properly, we're the company for you. We're going to keep our fees in line with you. You're going to win, hopefully. And like every other insurance policy you ever buy, you hope you never have to use it. And if you don't have to use it, then great. You get to win on the back end of this thing. But truth be told, and that's really where I tell business owners, what's your intent? If your intent is to avoid paying taxes, there's plenty of other people out there promoting this for the tax code, and go have fun with it. But if your intent is to mitigate risk for your business, to make your business stronger, safer, and better, then we're the company for you. And that's what it comes down to.
Fantastic. So you explained some real world examples. For example, as a company in the operating in the beach property that had to help them to withstand this Presume you
We're
reckon?
having so many conversations on that front right now. It's amazing, and it's really almost the same environment we had back in the mid '80s when insurance companies were just getting out of the business because they just couldn't. The reinsurance markets right now are really getting tight. I mean, they can hang out, get 9% investing in a AAA rated corporate bond and not take any
Yeah.
catastrophic loss on for their money. It's like, do you blame them? I don't blame them for that. So, I think we've gone one day in our country where we haven't had it defined as a catastrophic loss with between hurricanes, tornadoes, floods, all of those fun things. And unfortunately, whether or not, climate change going on or whatever, I just think there's people, we're living in higher density areas and catastrophic losses are going to continue from a human loss. I mean, it's just, I don't know any way about that. Well, traditional insurance carriers then are going to exclude risk and or charge the premium for it. But if they can't get the premium, then they're not going to insure you. I mean, I can go on and on about, especially our coastal states right now are having a really tough time right now insuring property, and it's becoming a big issue.
Mhm. Let's discuss a future outlook and consideration. So, for example, how do you see the landscape of risk management evolving, and what role can a captive or 831 plans play in helping
Yeah.
businesses adapt to future challenges?
Yeah, thank you for the question. I would say this. I think, like in our country, 401k, having a retirement plan for you and your employees, it just become a normal business practice. It's the way things are done. We feel an 831B plan will be the same thing. Where all successful enterprises will own some kind of form of a tax deferred bucket of money for insurance that's not being offered out in the normal markets. And now, when you look at brand coverage, look at brand damage today. You how much money? I mean, just personally, I pour a ton of money into my reputation as a company, and I would assume you do too. In fact, if I had to guess, but for you and I both, our biggest positive to our value, our intangible value, is our brand, our reputation, and we do what we say we're going to do. Unfortunately, it takes years to build that up, but literally seconds to destroy. Whether it was true or not, or whether it got posted, or somebody just made a mistake, there is a lot of things that go into that, and unfortunately, yeah, it's guilt. It's guilt by association. I mean, there's just a ton of things, the emotional and the psychological things that go on in the human mind, right? So those things are very complicated issues where I don't see traditional insurance ever picking that up as a brand damage type coverage. They might offer a little bit of PR on a sublimit if you have a cyber breach where, now your customers are being compromised and you have to make a news report, call the media up and say, hey, I've been breached or whatever, that's brand damage, but the sublimits are so small that it's a drop in the bucket for what it's going to cost. And I can go on and on about that. So the risk profiles are just getting more and more complicated for small to middle market business owners. When you look at the food, the supply chain risk, all those things that you're taking out of your hands today, but somehow you still got to represent those products. I mean, there's a lot of trust going on out there, and that's the way it is today. And whether you like it or not, it's the way it's being done. And the risk profiles that increases with, though, is significant to where I do think it's going to become a normal business practice, not out of the tax stuff and all that crap. And obviously there's incentive there. Congress, our government's the one that created that incentive. It's going to be because simply out of risk management strategies that these plans are going to become more and more popular. And we're seeing that now. I think we're seeing a lot of it in warranties. I think today, if you're going to be in retail, you promise so much to capture that consumer's confidence in your product, and or you want to retain that consumer back to your business. You offer them the world. When it comes to warranties, or we call it non-merchantability warranty, where simply the customer didn't like it and they have 30 to 60 days to return it.
Exactly.
No questions asked. You as a manufacturer distributor to those retailers are the ones that are picking that up. You're the one that bears that. If you want to do business with a company like Costco has our Costco over here in the US is very, very broad return policy. Well, it's the people that are manufacturing, selling, and distributing that product to Costco that is honoring that. It's not Costco. It's just part of the rules. If you're going to do business with Costco, this is what you're going to have to take on as a risk. Well, how do you want to fund that more efficiently and effectively is utilizing an 831B. If you're making a profit from Costco for doing this, Well, you're foolish for not taking part of it off, that profit off to the side and parking it off the side, knowing that you're going to have this coming back to you because it's unrealized profit. It's not realized profit until you get past that period of time where Costco doesn't accept a return anymore, right? So anyway, that's a whole nother animal in itself.
Yeah. Okay. So, in summary, if we summarize our interview for someone who is listening, would like to walk away with one or two major takeaways, what would it be?
I would say that this is a concept that you need to think about. If you're a successful enterprise, if you consult, work with business owners, we work with, by the way, we work with we work with people all over the world on this product. You can own one of these plans here in the United States. That's not a problem for us. And so we do all this stuff. It is a U.S. tax code, obviously, but there's a ton of advantages to do that from a foreign standpoint as well, which we're happy to talk to anybody around the world for that, to be able to have a plan here in the United States. But that's one thing. Then we own a website called 831b.com. We own the tax code domain. So 831b.com, that's a great place to start. You can go see my team. We have over 200 people around our country representing our products. There's educational videos. There's all sorts of things on there. But, Boris, like anything else, it's another tool in a toolbox at the right time. It's a great tool for the right client. And knowledge is power, and education, starting to educate on concepts like this, I think elevates your professionalism with your business owners. If we do our job and we continue to be on platforms such as yours, word's going to get more and more out on this code, and you don't want to be caught not knowing or understanding about it, in my opinion. And so we're educators first and foremost, and I think you owe it to yourself, you owe it to your business owners, you owe it to the risk takers out there. How do you mitigate it more effectively and efficiently? Is tools like this.
Awesome. So thank you again for this very comprehensive interview. And as always, we welcome our guests to be a guest on our platform at globalriskcommunity.com, where you can post your thought leadership content in form of blogs, discussions, and events. And if you have somebody who is producing content, you are welcome to point them in the right direction. And
thank you for that that's great, Boris. I appreciate that. That's good to hear.
Thank you again.
Take care.
Super.